Good afternoon, welcome to the TheoTrade Afternoon video. I'm Blake Young and today is September 4th, 2025, and we're going to compare and contrast this rolling week of the top performing and bottom performing sectors, and kind of an outlier in what we're seeing in the way the market is behaving from a normal rotation view. So as you can see, I have the S&P 500 compared to all the sector ETFs and looking for the strength and the weakness. You can see the long-term trend is up, and you'll also note that the S&P 500 is up about 0.3% for the rolling week, meaning we're looking back 5 days. So that does include skipping Labor Day and giving us a full 5 days of trading. As you're looking at it, the fact that the S&P 500 is second to only one instrument tells you again that the S&P 500 is overweighted into whatever this is at the top. You cannot have the conglomerate or the collected S&P 500 be the top performing without something lifting it there. So communications happens to be this one, not technology, but communications holding up, and we know that that spike is likely because of the ruling that Google does not have to sell off Chrome. Google and Apple performed really well, and they lifted the entire communications sector. So I don't want to chase this off of a singular event. If we kind of took that singular event out, we would probably be somewhere closer to about 0.6% in this climb through here. So I want to look at the ones that have changed, not just the top performing and bottom performing, the ones that have changed the most. And the thing that I like to look for is a line or a sector that has crossed through 3 or more other sectors. And this top one here and this bottom one here have done just that. You can see this bottom one went through 1, 2, 3, 4 different sectors right through there, 1, 2, 3, 4, to become the weakest. And this one right here has gone through, just in today, since yesterday really, the last 24 hours, this has gone through 1, 2, 3, 4, 5, and even outpaced the S&P 500 in the last 24 hours. So I'm looking for things that are changing direction, changing biases. And so the top one is financials, and the bottom one way down here is utilities. If you caught me earlier today, you saw that I want to buy utilities because I do think there's a real opportunity to trade into fixed income like utilities or bonds, but today is not the day. This week is not the week. When we looked at the year, month, and week, we're getting a conflicting statement from utilities, and so we're going to wait to be able to do utilities. So at this point, I'm not going to short utilities, but I'm looking at that as an indication that we're still in a sell-off mode and we need to wait for it to stop falling before we can step back into utilities for those high dividends. Which then leaves me with financials. If I take a closer look at financials, you can see that we have been trading in a very long-term trend pattern. This goes back multiple years, and we like to run in these blocks, in these channels. We broke through this, we've climbed up, we put a new 52-week high, we pulled back and retested the channel support. So the retest of this channel support and moving higher, theoretically, we could be looking for financials to duplicate this same channel. And the same channel as far as height and percentage, you can see it's a $2.40, call it 245, 250. We're talking about a 5% move off the lows. That means we are looking for it to go up to at least 245 off that low. Again, we'll say 250, so 55.50 or higher. We don't have to trade just financials, but why are we seeing this? Why are we seeing the futures outlook for financials is so positive that it's reaching 52-week highs? Why are we seeing that move higher? It's all on these rate cuts, all on the idea of lending and all the idea of expanding economies. So if we see rate cuts here at the Fed level shortly at the Fed meeting, then this theoretically is going to keep pricing in growth in the financial sector. If we look at the individual stocks inside of financials, and we can do that by going to Market Watch and either holding your shift key down and clicking on financials, or going over here to the left and clicking S&P 500 and clicking financials. This gives us a nice zoom in. You'll notice that the banks are the ones doing well. Consumer finance is doing well. And financial services, just like credit cards, these are transaction-based, not lending-based and growth-based. So I see this as that we're still concerned about the consumers. That's why all the transactions are down, but we're hoping and betting on bigger margins for the banks, cheaper borrowing cost and more borrowing to drive these higher. And again, more borrowing in consumer finance. If we see rates drop, that would make sense, and we'd expect these things to move. Let's go through the big banks first, just to highlight kind of what we're seeing and what the expectations might be. We'll start out with JP Morgan. JP Morgan put in a new 52-week high. We've pushed to these new highs, and we've broken through, and we've done on average volume. We're about done with the day, and we're probably not going to get a lot more volume in here. So it's a breakout on average volume. I still like the setup. I still like the trade, whether we want to call this an ascending triangle and target a move from about 280, well, call it 290 to 300 and look for a $10 move. That's fine. We can look for a 3% move in JP Morgan, and this 52-week high could be that breakout to run for 3%. But there's other ones that are a little bit better. As we walk through, they look similar, but we have more room to go. So if Wells Fargo mimics that, we could go 3% above the 52-week high. That's going to give us a lot more room. We're going to be looking at a net difference of 5 to 10% here. The question is whether this was enough movement to break us out in a kind of a bull flag pattern. I like this one a little bit better than chasing JP Morgan. But I like this from the run-up and the pullback, as today could be that breakout, and I'm looking for the bull flag to take us up to 88.75. It's kind of that 3% above the 52-week highs, if it can get there. Let's do two other big banks, and I want to get into a little closer look at regionals and consumer lending. But Citi, again, it's right near the top. I don't like it as much as I like Wells Fargo. But if it does break out of here, we're talking about a move from 91 up to, and I'm going to use this close, 97, and I'm looking for about 6 to 7% breakout through the high. We need a little bit bigger push today. It's not the confirmed breakout like the flag or the 52-week high that we saw in JP Morgan. Morgan Stanley is close, and if we get this consolidation to give us the new breakout, what I'm looking for here is that entire move. And we will go from here to here, because we already did put a 52-week high. And I'm looking for it to repeat this entire move, which puts us on track for 158 from 149. And now we have another 6 to 7% move. They're all roughly that size of move, 3%, 6%, 8%, somewhere in there. And so if we can watch for that bullish move, that breakout, I'd be looking for those to reach those new highs. The ones that might lend more are the regional banks. So we could go to KRE. KRE pushed through its 52-week high here. This could be considered a cup and handle, and so the cup and handle target still is in play. And you could say, as one of the things I like how Tony says, is we're owed a certain price. Well, we're owed 68.60. That means retesting the 52-week highs. If we are going to get there from here, we're going to 68.60, and then I do believe we're going to go for another 3%. So we could be looking at 70 as our target, 71, 72, and we have an additional 7 to 8% move higher on KRE, but I don't think we have nearly as much risk that we have to put on the table. We could buy in even now and put our stop about 64. So about for $1.50 risk, we could play for a $6 move and get a 4-to-1 reward risk ratio off of KRE. In the consumer lending space, we're going to start with American Express. American Express is not Visa and is not MasterCard. Visa and MasterCard is all about transactions. And so we look for transactions. We don't have the interest charge. We don't have the underwriting that goes behind it. So as we're watching this, American Express is a representation of a bank. They are the lender. They are the ones that are actually making that interest rate and the annual fees on the American Express card. So if we're going to see continued borrowing and at better rates, they can get larger margins, and we could be looking at this to duplicate what I consider a V reversal. And so this V reversal, or call it whatever you would like here, we already broke out and we've retested, so that for me there's opportunity in here to go all the way up to 362. So we're talking about a 10% move up in American Express. And the risk that you would have to take would be not very much. We just use the low here if we clear the high, and you'd have to risk maybe $7 to $8 to make $30. Now, Capital One Financial and Ally are really the consumer lending groups. These are the ones that do credit cards. They're the ones that do high-risk loans on cars. And so if we look at, say, Capital One Financial and Ally, I'm looking at these to give us one more run. I don't expect them to hold up for the long run. I'm expecting targeted moves on Capital One Financial and Ally. If rates are cut, we're going to see another push, another borrowing frenzy, And at some point, they're going to top out and reverse probably pretty hard if we get into financial difficulties. But right now, we're not seeing the massive defaults on credit cards. We're going to see possible lower rates, and Capital One Financial and Ally are set up to continue to go higher. But the move here, I'm looking for Capital One to clear the high and go up to 243. We're going to look for this about 8 to 10% as well. And at that point, at the 242, 245, somewhere in there, I will be looking for it to consolidate and reverse like we did back in February and March. But right now, it's setting up for the next push higher, and that 240, we'll call it 243 to make the math easy. Ally, A-L-L-Y, does not have the same credit cards the same way, and so we're going to look at Ally as one that is going to represent demand for refinancing of car debt or new cars. And the fact is, car inventories in the used car space is huge. And so you'll see deals and bargains coming through the used car industry, and Ally Financial will be there to swing in and lend the money on those cars. Until the defaults happen, this next move is what we're playing. And so I look at this and either bull flag off of the 37 to this high, which is today is the breakout, or the big picture, which is this low to this high, and I'm looking to see if it's really going to close up today. And if it does, I'm looking at Ally to give us a move all the way up to 45. There's another 10% move in Ally. Again, like Capital One, when it hits that target, that's where I want to step away and possibly start selling call verticals or go short or buy puts, because I do think there's some fundamental reasons that they will struggle after reaching this next target. This is the last hurrah in consumer finance from what I can see from an economic standpoint. But it doesn't mean that we fight the tape. We go with what it shows us, we go with what it sets us up, and a rate cut and more lending will cause an initial bump before we see any type of default on credit cards and car loans. So that's my next move. Long financials, waiting for utilities to stop falling, and we'll get back into utilities. But right now, long financials in the next couple of weeks as we go into the rate cut potential in September, and then probably be done and possibly going short before the end of the year. Thanks for watching, and we'll see you tomorrow at TheoTrade.